Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin wizard here with Swan Bitcoin. The system you live inside, the S&P 500, the retirement accounts, the index funds, has been rigged to funnel your hard-earned money into companies you don't understand, products you don't use, and lies you don't question. But now the snake is eating its own tail, because the S&P 500, the crown jewel of traditional finance, is about to become a Bitcoin ETF by accident. Not by choice, not because Wall Street suddenly got enlightened, but because of math, because of passive flows. Because if strategy gets included, the entire $50 trillion passive investment machine is forced to buy it. And when they buy it, they buy Bitcoin, whether they like it or not. So this isn't a story about choice, this is about inevitability, and inevitability is the most bullish thing in the world. Here's where the curtains catch fire. The S&P 500 gatekeepers keep a tidy checklist. You need a market cap over $22.7 billion, real trading volume, enough public float, and a full year of positive GAAP earnings. Strategy is over a $100 billion market cap company, and they swaggered in with a $10 billion profit for Q2 2025 thanks to fair value accounting on its 630K Bitcoin stack. String that together with the prior 3 quarters and 4-quarter earnings are solidly in the black. The company's market cap is 5 times the entry threshold, and bigger than a third of the existing index. And if liquidity is your question, well, the daily dollar volume looks like a small country's GDP, so the volume gate flies open. We're seeing some analysts put the inclusion odds at roughly 91% if Bitcoin stays above 95 grand. The committee can either rubber stamp strategy or admit their rules are performance art. The table is set, the passive flow tsunami is waiting, and the index is about to ingest a Bitcoin black hole. All right, let's talk about the raw plumbing. Roughly $16 trillion is tied to the S&P, and more than $10 trillion of that is on full autopilot. Index bots buying whatever the committee scribbles on the list. Picture a blindfolded robo-shopper with a black card. When strategy gets green-lit, the robot is forced to fill the cart with Bitcoin by proxy. Need proof of the hose pressure? When Coinbase sneaked into the club in May, passive trackers had to hoover up about $9 billion worth of coin shares in 48 hours just to stay in line with the benchmark. Analysts even counted 36 million shares physically migrating from skeptics into the passive hive mind. That was the dry run. Next, consider the index effect party trick. Goldman Sachs found that 74% of fresh S&P entrants now pop on announcement day, clocking an average 4% jump as passive money and front-running hedge funds dogpile into the ticker. Tesla's inclusion blew out trading volume so hard researchers wrote papers on it. Strategy carries the same nitro, except its fuel tank is full of Bitcoin. And the turnover math, the S&P's quarterly rebalance spins about 4.4% of the index, which at last count meant roughly $360 billion in forced trades blasted through a single afternoon. Even if strategy lands at a 0.15% index weight, you are staring at a $5.5 billion in mandatory buying from ETFs like SPY and VOO, plus copycat benchmark-hugging actives who fear underperforming a spreadsheet. So in summary, the index committee taps a pen, passive funds slam the buy button, and Bitcoin hitchhikes inside every 401k from Des Moines to Dubai. Resistance to Bitcoin is now mathematically futile. Here is the cosmic slap in the face. The planet's public equity casino weighs in at roughly $133 trillion. A number so large your brain files it under sure, whatever. The S&P slice alone is 57 trillion, which means Apple, Microsoft, and the AI bubble are basically orbiting a small moon made of cash. Now guess how much of that mountain is tied to Bitcoin. Go on, guess. It is less than 0.2%. That is the financial equivalent of a single sesame seed on the Big Mac of global wealth. Meanwhile, Bitcoin keeps rising like a radioactive sunrise, but legacy finance still treats it like a prank, Spoiler alert, the glitter is never coming off. So now we enter the realm of passive black magic, the spot Bitcoin ETF, BlackRock's IBIT. IBIT launched, cracked 80 billion in assets faster than any ETF in history, and is now flirting with 90. For context, that is like birthing a fully grown blue whale in the kiddie pool at your local YMCA. Every trading day, IBIT and its cousins swallow more Bitcoin than miners can dig out of cyberspace. Picture a conveyor belt where the left side drops 450 coins per day. Meanwhile, the right side is a Kirby vacuum inhaling 2,000. The net effect is a supply deficit of Bitcoin so chronic it makes the oil embargo of 73 look like a garage sale. Fidelity, Invesco, ARK, they all joined the buffet. Collectively, funds now fund custody roughly 6% of all Bitcoin that will ever exist. And they accumulated most of it while regulators are still filing their paperwork. Think about that. Your Uncle Bob's lazy robo-advisor is now a stealth Bitcoin maxi. Simply because the portfolio model switched commodities exposure from gold to digital gold. And the best part, these ETFs rebalance automatically. If Bitcoin moons, the net asset value balloons. Index funds rebalance up, advisors chase performance, and round 2 of the great gobble begins. The ETFs do not celebrate, they don't even blink, they just convert fiat into 21 million pre-programmed tokens until the heat death of the dollar. Congratulations, the passive herd of the ETFs has become the world's most relentless Bitcoin accumulation machine, and they're doing it with other people's money. Because of this, Bitcoin is going to pump and Strategy's balance sheet is going to inflate, and the stock is going to rip higher. Because the market cap is bigger, the S&P weighting model says buy more Strategy. Index funds will obediently shovel billions into the ticker, which pushes the price up again, giving Strategy even cheaper equity for the next convertible note. Then they're going to issue that paper, scoop up more Bitcoin, tweet more laser eyes, and the cycle restarts like a hypnotic GIF. Meanwhile, those same index funds hold Bitcoin ETFs. As Bitcoin rallies, IBIT's net asset value is going to swell, forcing the balanced portfolios to rebalance upwards, so they dump the bonds, buy more IBIT, and off we go. Every incremental inflow of these flywheels is going to tighten the supply, which nudges the price, which fattens the market caps of every Bitcoin exposed company, which will further attract the momentum algorithms and thematic funds, which is just going to drive the price again. That is not a virtuous circle, that is a financial centrifuge that spins fiat into Satoshis until the bearings melt. And then you got to add the miners to the merry-go-round too. The higher price of Bitcoin means the fatter margins, so investors pour capital into miner stocks, index funds are going to follow, the hash rate climbs, network security strengthens, and institutional comfort rises. More allocators greenlight Bitcoin, the price pumps again. The loop has loops inside of it like a fractal built out of orange spirals. The bottom line is that the legacy system tried to ignore Bitcoin, but its own passive plumbing has turned it into a self-reinforcing orange feedback machine. Once it starts, there is no emergency stop button. Buckle up, we're about to achieve liftoff velocity. Thank you so much for listening. My name is Adam Livingston, and I am the Bitcoin Wizard. Please like this video and subscribe to Swan Bitcoin for more daily incredible content. Class dismissed.